Okay, so let's talk about cash. Let's talk about how to separate operating cash from excess cash on the balance sheet so that we can at least make a few possibly futile attempt to identify how much cash a firm needs for its operations versus how much cash it's just holding in its savings account because it doesn't have anything else to do with it. Okay? Now, this is, again, not going to be the case for every firm. Some firms may only hold the amount of cash that they need for operations. What we are going to have to try to do is sort of a mix of the following 2 or 3 methods. Okay? So the first method, super easy, super direct, but has the most potential for error. Okay? So the method 1 says anything in excess of 2% of revenue is excess cash. So what we want to do is we want to look at revenue in the current year. We're going to calculate what 2% of revenue is. If the cash balance on the balance sheet exceeds that number, exceeds 2% of revenue, we consider it excess. If it's less than 2% of revenue, we consider it operating. And so if the firm has less than 2% of revenue in cash, we just say that all of their cash is operating. If they have more than 2% of cash, then they're going to have some operating cash and some excess cash. Now, because this is just a fixed line, there's no room for any nuance here, right? So there's no room for potentially having a firm that does need more than 2% of revenue to manage its operations, right? Some firms might and are likely cash-intensive businesses. They use a lot of cash, and so they would need more than 2% of revenue, and a method like this doesn't identify that. So this is a decent sort of first pass. If we think that the firm's cash balance looks really high, we could just calculate 2% of revenue and see relative to that whether the firm is holding a ton of cash just based on this sort of rudimentary measure, but it's not really going to be the best measure. Method 2 is probably the one that is the probably most commonly used. I guess it bridges the gap between being not really computationally intense, not really complicated, but still being complex enough that it deals with some of these issues. Okay? So method 2 is what we do is we look at the industry average cash holding. Okay? So we look at all the other firms in the industry and we say, one of the reasons why we don't like method 1 is that potentially it misidentifies firms that need a lot of cash because the industry is cash intensive. Well, method 2 takes that into account explicitly. And it says, okay, let's look at every other firm. How much cash are all these other firms holding? We'll take the average or the median of the cash holdings of all of the firms in the industry, and we'll say anything in excess of that. So if you're holding more cash than the average firm in your industry than your competitors, then you're holding too much cash. Right? So if we take our UPS and FedEx example, and there's not really too many other competitors in the industry really on that scale, but if UPS has twice the amount of cash that FedEx does, then we can be reasonably certain that UPS is holding excess cash outside of what it needs for operations. Okay? But it's not a guarantee. Again, there is no guarantee because we can't, unless we're inside the firm, we can't know why the firm is holding the cash that it's holding. And there are a number of different reasons why a firm could be holding cash. Okay? So what we are trying to identify is at least the best method to alleviate that issue. Okay? Because again, cash is being stored in a savings account, essentially. It's earning a very low return. And we want to make sure that we're not including that unnecessarily in our calculation of invested capital, because if we do, it will decrease the firm's return on invested capital and make the firm's performance look worse. Okay? So we look at we try to identify if there's an industry trend, and we identify the excess. Now again, it's not perfect by any means, because if we looked at, say, the excess cash holdings in the tech industry, well, we would have the average of cash holdings would include firms like Apple and Facebook, Amazon, and Microsoft, and those firms all hold an enormous amount of cash. Apple at one point had like $250 billion in cash. Microsoft had $100 billion in cash. All of them have multiple billions in cash. There is no way that even firms of that size need that much cash on hand. Okay, so if we looked at the industry average for the tech industry, we would get a massive, massive average, a huge amount of cash holdings. we would estimate that to be required for operating, but we would be deceived simply because of the amount of cash that they're all holding. So if all of the firms are holding just a huge amount of excess cash, then method 2 is not going to identify what we want. And method 1 might even be better. Right? We might want to say, okay, well, if we go back to the 2% of revenue, maybe we could look at 2% of revenue and identify that the industry average is already into excess territory. Right? But really what we would do in that case is go on to method 3, which is to run a regression analysis. And what we would try to identify with a regression analysis is all of the reasons why a firm might hold excess cash. Or might hold cash at all. Okay? So what we're trying to identify here in method 3 is a bunch of different reasons why a firm might hold cash. So look at all of the in the independent variable column, right? So market to book is a measure that is typically used to define whether a firm has high growth prospects. So a firm with a high market to book ratio has high growth prospects, so they expect to grow larger, and that is a pretty significant reason why a firm might need cash to invest. And so we would say that market to book should have a positive relationship on a firm's need for cash. Right? The firm's size will have a relationship with cash because bigger firms are probably going to need more cash for operations. The firm's cash flow, the firm's working capital, the firm's capital expenditures, those are all investment. So a firm might use some of that cash in investment. The firm's total debt, the firm needs cash in order to pay its interest on its debt. The firm's R&D, its dividend payment, right? Both of those would potentially be cash heavy. All of these things are going to say, what is the relationship with all of these firm-specific measures and the firm's need for cash in the future? What we're trying to identify is a relationship that might describe how much, specifically for this firm, how much cash they need to operate. And if we can use a regression to do that, then we can identify any cash that's in excess of that. Right? Now, again, this isn't perfect because, of course, we can't identify perfectly all of the reasons why a firm might need cash unless we're inside the firm. Right? Again, all of this is presuming that we are external to the firm. If we're the management team, we know exactly how much cash we need to operate the firm, and we know precisely why we're holding all of this excess cash or any additional cash that isn't operating in nature. So the separation is as simple as that. If we are, consultants working for the firm or we're a management team, we don't have to do any of this estimation, any of this assumptions. But if we're external to the firm, we're trying to make the best assumption we can. And a regression probably gives us a good, one of the best measures, but of course it is a little more computationally intense. It's a little more complicated to run. If you guys aren't familiar with regression, you can let me know and we can talk about it. I can make a video about it or something like that. This isn't a statistics class, but I'm happy to make a short video about regression if somebody's interested and doesn't really understand how this is working. Okay, but a regression is just a way to identify a relationship between several things. And here the relationship is between all of the firm's potential needs for cash and the actual cash that the firm has. And we're trying to say, okay, the firm needs X amount of cash based on all these measures. It has Y amount of cash, and that means Z is excess, and everything else is operating. Okay? And then we are going to the other side of the total funds invested equation. The financing side is going to include debt equivalents, equity, and equity equivalents. And this is essentially all of the sources of capital for the firm. Okay, so what we are identifying here, and the identification process here is pretty straightforward because this is everything else on the balance sheet that isn't operating. So we went through our balance sheet and we checked off all of the operating assets, all of the operating liabilities. Everything that's left has to be the other side. It has to be debt or debt equivalents because we identified it as financing. Or it has to be equity or equity equivalents because we identified it as non-operating. Right? So debt is pretty straightforward. Debt is anything that is interest-bearing. So if it has an interest rate, whether it comes from a bank or from the public bond market, it is considered debt financing. Debt equivalence is going to be anything that is like debt but is not specifically an interest-bearing debt instrument. Okay? So that is going to include things like off-balance sheet debt and one-time debts that aren't part of sort of ongoing operations like severance payments, or we talked a little bit about unfunded pension liability, so money that we still owe to the pension plan for our employees. It might include things like a lawsuit that has been settled against us, and so we owe the plaintiff and the lawsuit money. It might include things like environmental remediation if we, say, run an oil plant that's been shut down and the government has said that we need to clean it up and return it to its original environmental state. All of those things are like debt. There are things that we owe. They're a liability to the firm, but they are not specifically an interest-bearing instrument, right? So it's not a loan that we took out that we pay back with interest, but it is a liability, a financial liability that we still owe someone. We just don't owe it with interest. Okay. So we're trying to identify all those things, and we're going to include that with debt and its equivalence. And we'll have a chapter talking in more detail about some of that stuff. Then equity and its equivalence, where equity is all of the sort of original investor funds, so any common stock or any preferred stock that it's sold. The firm has raised money by selling shares to outside investors. That's original investor funds. And then any investor funds that are reinvested into the firm, like retained earnings and accumulated income. So this is money that we could be returning to our investors. Remember, retained earnings comes out of net income, and net income is split into retained earnings and dividends. So dividends are returned to our equity investors. Retained earnings could have been sent back to those owners. Instead, we're keeping it to reinvest in the firm. That's still considered to be equity. Right? Equity equivalents are going to be any claim on the firm, on ownership on the firm that isn't related to the sale of shares. Okay. So there are going to be some sort of non-cash adjustments to retained earnings. We'll talk about those. There are going to be like deferred taxes and income smoothing provisions. This could be, for instance, a minority shareholding so somebody else owns a small stake in the firm. Things like that that we have like traded away. So equity equivalents are a little more complicated. Again, we'll have a chapter that goes into more detail on these debt and equity side. But what the answer is that total funds invested. So all of these things need to equal the invested capital on the other side, that we invested capital plus non-operating assets.